what I want to focus on really is give some texture to a perspective that I am finding more and more compelling among PE firms, sovereign wealth funds, and corporates about emerging markets generally. And I wasn't able to make this morning's presentation about the global economic outlook, but I would imagine that what Beth explained was that the rate of growth in GDP terms of emerging markets relative to the advanced countries has been in the last decade and a half, 2 to 3 times the rate. And that gap, that delta of 2 to 3 times the rate of GDP in emerging markets in general is going to continue as long as the eye can see. And that is the consensus both in the market and among policymakers and government officials in the emerging markets themselves in general. And most importantly, as the pie, as the global economic pie continues to grow, unless there's a complete shrinkage of the world economy, what's happening is the pieces of the pie, of that growing pie, that are, as a result of emerging markets growth, is becoming larger and larger. So it's not necessarily the BRICS, but it's many emerging markets have now become the engine of global economic growth. And the US cannot do it alone anymore. And I think very few people understand the math and have looked at the data. I guess I'm cursed as being an economist, and so I've done that. And when you do these mathematical calculations, it's really true that emerging markets have become the engines of global economic growth. And so when you think about the fact that the emerging markets are growing 2 to 3 times the rate of advanced countries, that they're driving world economic growth, the conclusion that I draw, again, I think are supported by the data, is that this represents a secular transformation in the global economy. And by secular, I mean a structural long-term change. That unlike other investors who believe that emerging markets are the investment du jour, and that this is a cyclical phenomenon that we're witnessing, it's not. This is a long-term secular change, and I want to sort of give some reasons why I think it's secular in nature and why I think the genie is out of the bottle across a wide array of emerging markets. Again, not simply the BRICS, Brazil's, Russia, India, China, South Africa, but many countries in Asia, in Latin America, and in sub-Saharan Africa. Pound for pound, risk-adjusted rates of return are every bit as high, in some cases far higher than they are in the BRICS. And I've spent 34 years working in these markets and have a pretty good feel for their texture. And I think the last point I'll make at the very top about the secular notion is that what I find very ironic in this description is that when you looked at the financial crisis of 2008 to 2010, which region of the world actually proved to be the most resilient in an economic sense and in a policy sense to the crisis? It was sub-Saharan Africa. And this is not terribly intuitive to most people. So when you do the math, and I've done this, I've published it, you have the initial conditions of every region of the world, and you look at what happened over the course of the two to 3 years during the crisis, Africa, sub-Saharan Africa, actually outperformed everybody. Why is that? And I think this epitomizes the case with emerging markets in general, is it's because there are hard-won reforms in a large number of sub-Saharan African countries, but most importantly, and this is what I look at when I think about investing and advising investors in these countries, is you look at the quality of the policymakers, the economic policymakers in particular. And when the crisis began to hit, and at that point I was still in the World Bank, the big fear was, particularly in sub-Saharan Africa, but in general among the emerging markets, is these guys are going to now slap on price controls, there's going to be protectionist policies put in place, and this is really going to just exacerbate a problem that actually started in the financial sector in the US and the EU and then migrated to the real sector worldwide. You know what? Most of the protectionist policies, most of the price controls were put in place by Russia, by Turkey. the US, very few, if any, in sub-Saharan Africa. Now, this is, again, it's very surprising, but what it shows you is that when you have trogged along and had made some really difficult reform choices, you don't want to slip back. And a lot of these economic policymakers in emerging markets, and I think sub-Saharan Africa epitomizes it, are really smart and have been through the mill, and they know what it's like, and they don't want to have it slip back. So what are the reasons why I think that this is a secular change? I think one, and this has been written about, and it's in the pamphlet, is the rise of what I would call a consumer class, not a middle class, but a consumer class in emerging markets. And the rate of growth of the percentage of the population who are active consumers is accelerating far faster than anybody thought, including my former colleagues at the World Bank or the IMF. And so the rate of change of the rise of the consumer class is surprising, and I think it's a really important point to think about. And the discussion about China and the focus on consumer and retail clearly is on target. But I think the second part of the consumer class rise that makes this a secular trend is that the sophistication with which purchase decisions are being made is also increasing. And this could be at the individual level in a store, it could be at a government procurement officer, it could be a corporate. And increasingly what I've been seeing is purchase decisions are increasingly made on a life cycle present value basis. And so, one of the stories I like to tell in a book I wrote on Chinese and Indian investment in Africa, we did a case study on blankets being sold in kiosks in South Africa that were manufactured by the Chinese. And they were extremely cheap and inexpensive blankets, but they sold like hotcakes because they were so cheap. The problem was that when you take the blanket and you washed it, the dye ran out and the blanket shrunk. And they became known as the wash and cry blankets in South Africa. What happens? The Indians come in, and this is just like a textbook economics. They come in and they make a slightly better quality blanket that doesn't shrink and the dye remains in. And they eviscerated the market share of the Chinese blanket manufacturers in this particular market. And it just shows you, as Charlie said about Russia, and it's true of any economy, people respond to incentives. And so I remember one time in Uganda, the Minister of Agriculture, saying, I wish we had not bought, this is not to be discriminatory towards the Chinese, but I wish I had not bought that really cheap off-the-shelf set of tractors from China. They were the cheapest. I saved money. I saved my government money. But 5 years down the road, you can't replace the parts, you can't maintain them, and he sort of smacks his forehead and said, I should have bought the John Deere. It was twice the price, but in present value terms, it was a far better purchasing decision. And you're beginning to see this time and time again. And when I see that in an economy, that means that something is happening. And you really have got to pay attention to that. I think the third thing that's happening in emerging markets is the notion that one of the theories of foreign investment, foreign direct investment, is the product life cycle theory, that inventions are made in advanced countries like the US and the EU. As time goes on and they saturate the incumbent market and they want to get to the next geographic market, the product is dumbed down and commoditized a little bit, and that changes from invention to innovation. And then by the time it gets to the emerging markets, it's truly commoditized, right? And Ray Vernon, former professor of mine at Harvard, wrote many articles and books based on this notion. Well, what's happening today in emerging markets is the product life cycle is being turned on its head. So if you think about mobile money, M-Pesa, in Nairobi, you cannot take, and you could not have taken a cab in Nairobi in the last 10, 11 years and actually paid cash. You had to use your mobile phone. Well, what happens? Apple all of a sudden has introduced, and there are many other examples, but Apple has introduced, Apple Pay. Of course, now they're under threat because of cyber attacks, but it's it's really important to understand that when you don't have an incumbent technology and you have smart people and you have a need, in this particular case, you don't have rural banking and you don't have rural telcos, you combine the two together. And so you create something that today now seems really, pretty run-of-the-mill. But it was not invented in the advanced countries at all. And it's only now coming to the advanced countries. And there are many other examples like that. And so again, I think paying attention from a secular standpoint about what's going on in emerging markets is really important. A corollary to that, and I think this is really important, is there is a blurring of sectoral boundaries that's occurring. And it's occurring worldwide, but it's occurring particularly in places like emerging markets because there are not the incumbent sectors and technologies. And again, mobile money is a perfect example. Investors worry if they want to go into the mobile money space or they want to go into the banking space or the telco space, as mobile money and that whole notion of payments over the internet or mobile devices gets more and more routine, the question becomes, so who are you? Are you a banker? Are you a telephone company? Are you both? Which regulations do you fall under, right? And it's going to be a thorny question, but the place of the world where this is going to be fought out and is being fought out now are the emerging markets. Again, from sub-Saharan Africa to places like Myanmar. And I think, again, this is a really significant attribute to pay attention to when you're thinking about the emerging markets. There are other trends that are important in terms of there's a demographic dividend that's going to take place in Africa in about 10 years' time, where there's going to be a lot of young, hopefully able-bodied workers that is going to be able to support an older generation. It's sort of the flip side of what's happening in China. So I think there are reasons to think about emerging markets in a very different way. And the term that I think about this is that this is not your grandfather's emerging markets. Now, there certainly are risks, obviously, associated in investing anywhere, and in particularly in emerging markets. But I want to make a few comments about these risks. First and foremost, most of the risks in various emerging markets are misperceived. For the most part, they're exaggerated, they're overestimated, and for the most part, the opportunities are underestimated. And I think sub-Saharan Africa is an absolute case in point. If you spend your time going from country to country, you look at enterprises, you look at investment terrains, the perceived risks don't match with what you'll hear back in New York. And the perceived opportunities don't match with what you hear back in New York. For me, those are opportunities for arbitrage. I love misperceptions, right? That's where you make your money. The other thing about one of the other secular changes in risk is the growth of investment and trade among emerging markets, so-called South-South trade and investment, right? Historically, again, back in the Ray Vernon times, typical investment flows or trade flows were from the north, the advanced countries, to the south, advanced to the emerging markets. Now, about 25% of global trade is trade among emerging markets. Has got nothing to do with the advanced countries. 1/3 of any outbound FDI project from an emerging market is going into another emerging market. That has tremendous competitive and risk concerns for advanced country investors thinking about the emerging markets, because it's no longer the case that if you're GE, your competition is likely and increasingly is less Siemens. It's more likely, the analog from Brazil or from India or from China. In fact, at one point in time, Siemens was a client of mine, and recently GE was, and they're actually talking about how can they go to market together to fight off third party in third country competition. And so the risks of not understanding the changing nature and the changing identity of who your competitors are is, I think, going to increase. And another sort of click on that is what most people don't recognize is that high tariffs, non-tariff barriers are more a feature of the emerging markets than of the advanced country markets. And so what you're seeing a lot of are protectionist actions by governments in emerging markets against other governments in emerging markets. Take the case of Nike and athletic footwear, which are produced in China, exported to Brazil. And about 4 years ago, the Brazilians accused the Chinese of dumping. And I was approached by Nike and other athletic footwear companies and say, well, we can't go to USTR because this has nothing to do with the United States. We need help. We need to understand how you make investments in this kind of world where there's a tit for tat going on between Brazil and China, and we're caught in the middle because we're using China as a sourcing platform. And again, I just use that as an example. So I think the last thing I'll say is, how do you deal with these risks? And this is what I launched a new business at PwC. I've now retired from PwC and I've set up my own firm to de-risk these types of deals. And I've, a couple of lessons for me at least from doing this. One is doing reputational due diligence by an independent third party who has no stake in the game at all. And by reputational due diligence, I mean understanding who the stakeholder is in a 360-degree way. I'll give you a very quick story. I had a client, very big US firm going into Myanmar. And the oligarch and former general who was published in WikiLeaks as owning the facility that this client wanted was obviously on the special designated list, and so this asset was off hands to this American firm. They hired my team and me and my colleagues in Singapore, and we actually looked at the corporate records. We talked to about 40 people around this particular guy. Obviously, he doesn't know he's being investigated. And what we determined after 3 weeks on the ground in Yangon and in some other places in China and Singapore, this guy actually had no financial interest in this asset at all. So and he was written up in the FT and the New York Times and the Wall Street Journal as being the most notorious, wealthiest guy, and he owns this, that, and the other thing. This was a truly market first mover advantage for my client to be able to discern what I would call sort of a type 2 error, a false positive. So doing that kind of reputational due diligence by an independent third party, not someone in-house, not a law firm, but someone who understands the politics and the institutions is really important. I think the other aspect to this stakeholder notion is, and I thought Charlie was going to talk about this in Russia, because this is what I advise clients who are thinking about Russia, but it's the same thing in China and Brazil. When you have a large geography, is deals can be done most easily at the local level in the regions, right? In Russia, you go further east, much easier to do something with a governor. But what's important is understanding who all the various stakeholders are in this particular oblast or region or state, and get them to have skin in the game in some fashion, either because of the tax base, because of jobs created. And what you want to do, and I've done this for a couple of big firms going into Asia and to Africa, you want to essentially build an inoculation unit around the project so that if some vested interest or some new entrant comes in and wants to pee on the project, he's playing or she's playing with fire, because you've got, as part of the project, people who have an interest in making this thing a success. The last thing I'll say, and I think this speaks to what 57 Stars does. I know it certainly did when I was at Albright, but I think it's becoming more and more mainstream now, is the notion of what people would used to call sort of corporate social responsibility or public-private participatory investments are becoming mainstream. And you can actually lower your cost, raise your bottom line, in fact, raise your top line by bringing in local partners who can supply things. And so I think the case of Coca-Cola in 3 sub-Saharan African countries about 4 years ago epitomizes this point. They teamed up with a small consulting firm called Technoserve and funded by the Gates Foundation. And in 3 countries in East Africa, Kenya, Uganda, and Tanzania, Coca-Cola set up a series of model contracts, invested in infrastructure across a diffused set of about 1,000 fruit farmers, to be able to have those farmers supply the fruit for Coca-Cola's juice manufacturing in East Africa. Heretofore, they were importing fruit from Asia, spending foreign exchange, you got corruption on the border and so forth. And they changed completely their supply chain, lowered their costs, created jobs, expanded the tax base, but more importantly, to my previous point, they then made allies among 3 governments that do not piss on this project. And it's very successful, but it epitomizes what is happening more and more, that Coca-Cola did not do this simply because this made them look good. They did this because it actually helped them commercially. And I'm seeing more and more of this as a mode of investing in emerging markets. And I think it's beneficial on all sides. So I'll stop there. I said I'd stick to my time, and I think I have.